Hello and welcome to our latest quarterly update. As usual, these videos are being produced to accompany our quarterly written report. In this video, we'll look at what's been happening in the global economy and how that's been driving some of the various asset classes. And then in video 2, we'll look at how all of that has affected portfolios. And once more, all of the headlines have been dominated by America, particularly Donald Trump's trade tariffs, but also things like US monetary policy and artificial intelligence, which has been really driving both markets and the US economy. So let's look at some of these topics in turn, starting with tariffs. If we think back to April this year, when we had the Liberation Day announcements, where Donald Trump announced all of his trade tariffs, remember markets really didn't like it and they reacted really badly and sold off quite strongly. So this chart shows how some of the main parts of the stock market have done so far in 2025. The red line on here is the main US market, the S&P 500, whereas the blue line represents non-US stocks. And the green line is the so-called Magnificent Seven big tech stocks. And you can see, as we said, all of these fell sharply back in April, but the non-US stocks probably held up that little bit better. The main US market was actually down about 20% peak to trough, and the Magnificent Seven dropped around 30%. Now remember, a tariff is essentially a tax on imports. It's going to make imports more expensive. So that means that either American consumers would have to pay more for goods, or perhaps the company doing the importing might have to make a smaller profit. Either way, those tariffs were not seen as very good for the global economy or the stock market, and in particular, pretty poor for the US. However, Trump then announced some changes and some delays to some of those tariffs, and that was the catalyst for stocks to recover. Now, in a way, the extent of that recovery has been quite surprising because in a lot of aspects, not much has changed since Liberation Day. And this chart shows the effective tariff or tax rate on US imports. The purple bar is what was announced on Liberation Day, just over 24% tariff rate on average. The current levels, which are a little under 20%, are shown by the blue bar. So the actual tariffs are at the moment lower than what was announced, but not by very much. And it's still worlds apart from what we saw prior to this year, around 2%. And you can see the grey bars on this chart show previous years. The current level of tariffs is still significantly higher than at any time since the 1930s. So the difference is massive. And actually, as yet, we still can't really assess what impact it will have on the US economy. Because a lot of those companies managed to get ahead of tariffs, if you like. They front run the tariffs by importing things before the tariffs apply. They knew the tariff announcement was coming, so they tried to get all those imports done in advance. So we've not actually yet seen the impact of those tariffs on the real economy. We think it's going to be sort of spread out, delayed, but at some point that impact will apply. So let's come back to this chart, and from this we can see that the big tech stocks in particular bounced really strongly after the lows in April, and in fact they've now almost caught up with the non-US stocks this year, but we'll talk more about those tech stocks in a minute. But it is worth noting that those non-US stocks are still ahead this year, and that's been a bit of a change to the trends that we've seen over the past decade or so. So this table shows various asset classes over the last 10 years, and it shows which have done better or worse in each year through colour coding. So green for better returns in that year, red for lower returns in that year. And this can throw up some anomalies because sometimes something could be red but still produce a positive return, but it's all just relative returns. Now we call this the patchwork quilt, and we often use this to illustrate just how unpredictable markets are and how difficult it is to try and decide where to allocate your money, because often one of the best performers in one year, for example, can be the worst in the next year. So it's an intentionally a busy chart for that reason, and it sort of shows why we need to have a diverse portfolio. But there are a few things we can observe from this. Firstly, we can see that the US market has clearly had more green periods than most. But this year, it's actually returned less than all the other stock markets that we're showing on here. So it's returned less than 7%, where some of the others, most of the others are all double digit. Europe and emerging markets have actually returned more than 20% this year, and actually the UK, the FTSE 100, is not far behind. Another thing we might observe is that there's lots of red in UK real estate, and that shows it's had a very poor time of it over that period because it had things like Brexit, the pandemic, changing trends such as the move to online shopping, and it was also hard hit by rising interest rates in 2022. But on the other hand, we can see that it's often feast or famine. It's had a couple of really good years in that period. So sometimes those happen after a very poor return. Sometimes we see a very sharp recovery. So perhaps one might be due sometime soon. It's certainly something we're looking at. But so far this year, what we can see is that all of the asset classes are up, and that includes fixed interest as well as equity. It's not gone up quite as much, but that's not what we'd expect. But all the portfolios are therefore up as well, more of which in video 2. Now, I mentioned that some of those big tech stocks have bounced back really, really strongly, and they are back to outperforming the rest of the US market, which is the sort of trend that we've become used to over the last couple of years. And a lot of this is to do with AI, artificial intelligence, and actually this tech spending, or the tech companies, are having a really big effect on the US economy. There's a huge amount of capital spending going on as companies like Microsoft, Meta and Google try and beef up their AI capabilities. A lot of this is spending on things like data centers, which need lots of electricity and lots of microchips, and that's actually fantastic for the likes of Nvidia, who make those chips and then sell them to the other big tech companies. They are now the world's biggest company, valued at over $4 trillion. And in fact, a lot of the tech companies seem to be investing a lot of their money in each other. But all of this spending has helped the American economy to keep growing, even as consumption has dropped. And this chart from Deutsche Bank shows the underlying growth in the US economy and how it's changed. So that's the dark blue line, but the light blue line is what would have happened without all that tech spending. And interestingly enough, it would barely have grown in the last 2 quarters. Had it not been for all this investment. Now that's fine, but we do worry about what will happen when that investment spending inevitably slows. At some point, the tech companies will need to see a return on their investment. We will hopefully see some improvements in the real economy through productivity gains, for example. So that's things that we'd like to see. Hopefully they will happen. But in the meantime, it's just something that we just need to be aware of, because the tech companies and the spending that they are doing is driving such a big part of the US economy. And finally, staying in the US, the other big driver of markets at the moment is monetary policy. So what is happening with the US Federal Reserve, their central bank? And again, Trump is having a big impact here. He's made no bones about the fact that he would like interest rates to be a lot lower than the Fed has recently set them. He's talked about wanting to fire Jay Powell, the head of the Fed, and install somebody in place instead who's much more likely to have the interest rates at the levels that Trump would like to see. He's also recently tried to fire another member of the rate setting committee, Lisa Cook, but for now the courts have blocked this. But we've also had another Fed member resign, and they've been replaced by a guy called Stephen Miran, who was one of Trump's economic advisors. Now, his actions might give us a clue about what a remodeled Fed could look like. So 4 times a year, the Fed publishes what we call the dot plot. And essentially, each member of the committee is asked where they think rates will be at the end of each coming year. The views are anonymous, and they put them on these charts, so each dot on here represents a different committee member's views. And it's pretty clear from this that there's one member who thinks rates should be a lot lower than the others, by about 0.5%. Now, we don't know for certain, but we assume that that's Stephen Miran. And in fact, the lowest vote in each of the next few years is about 0.5% lower than the rest. And because of the way the committee works, it only takes a swing of 1 or 2 votes to make a difference. And with a few people's terms coming to the end, we can expect them to perhaps be replaced by people whose views are more in line with Stephen Miran's. So as a result of all this, we think there's a reasonable chance that US interest rates might be quite a bit lower in a year or so's time, for example, than would have otherwise been the case. And that's positive in the short term for US stocks and bonds. and it's positive for the US economy. However, there is a little bit of a danger that if rates are kept too low for too long, that might have a negative effect. So the US economy could overheat, which makes it more liable to then have a sharp downturn afterwards. And of course, it could lead to higher inflation than we might have otherwise been the case. So we do need to be careful where they put interest rates. So there's lots going on, in particular in the States, and all of this is having a big impact on global asset classes. And in video 2, we'll look at how that is affecting portfolios, what returns have been like, and how we've been positioning portfolios to try and adapt to these changing market conditions.